The first stock I bought because a coworker mentioned it in the break room. I didn't research it. I didn't understand what the company actually did, beyond a vague sense that it seemed up and coming. I bought it because someone else sounded confident, and confidence, it turns out, is extremely contagious and tells you almost nothing about whether a decision is any good. I remember feeling almost proud walking back to my desk, like I'd just done something adult and decisive. I checked that stock every single day for about 3 months. Some days it was up, and I felt like a genius. Some days it was down, and I felt slightly sick. I sold it eventually, for a small loss, mostly because checking it every day had become exhausting, rather than because I'd learned anything useful about the company itself. Looking back, I'm not even sure I could tell you what that company actually made. This isn't a video about which stocks to buy. It's about something almost nobody explains clearly before handing someone a brokerage app, that a portfolio isn't a collection of clever picks. It's a structure, built once, designed to survive years of exactly the kind of behavior I just described. Everything in this video is general education, not personalized advice for your specific situation. The goal is to help you understand how the pieces fit together, not to tell you which pieces to buy. Here's the myth worth killing first. We assume building a portfolio means finding the right investments. Mostly, it means deciding on a structure before you touch a single investment, and then having the discipline to leave that structure alone. The picking part is almost the least important decision in the entire process, and it's the one that gets nearly all the attention. There's a second myth worth naming before we go any further, that a real portfolio requires a large amount of money to start, so it's not worth building one until there's more saved up. Most modern brokerages allow investing in fractional shares of a broad fund for whatever amount you actually have, even if that's $25 this month. The structure matters more than the size of it on day one. A small, well-structured portfolio started today has years more time to compound than a large, well-structured one started 3 years from now, once enough money has finally accumulated. The 3 years spent waiting for enough almost never get made up later, no matter how much gets deposited once the waiting finally ends. Let's start with the first real decision, because it comes before any specific fund or stock. How much of your portfolio sits in ownership of businesses, and how much sits in loans to governments and companies? Stocks and bonds behave differently. Stocks tend to grow more over long stretches of time, but swing harder in bad years. Bonds tend to grow more slowly and generally behave differently from stocks, though they can lose value too, particularly when interest rates rise. The cushioning they offer is a matter of degree, not a guarantee. Neither one is better. They're different tools solving different problems, and the mix between them is the single decision that shapes your entire experience of investing more than anything else you'll choose afterward. There's a rough, well-known heuristic for finding a starting mix, and it's worth naming clearly as exactly that: a heuristic, not a rule, and definitely not personalized advice. One old version subtracts your age from a round number like 110 to get a rough starting point for how much of a portfolio might sit in stocks, with the rest in bonds. It's only a rough starting point, though. Your actual time horizon, income stability, retirement needs, and ability to tolerate losses all matter more than the formula itself. Younger investors, with decades ahead of them, lean more heavily toward stocks, because they have time to ride out the bad years. Someone closer to retirement leans more toward bonds, because a bad year matters more when there's less time left to recover from it. It's a starting conversation, not an answer. Someone with an unusual risk tolerance, income situation, or timeline might land somewhere completely different, and that's a conversation worth having with an actual professional who can look at your full picture. I have a friend who ignored this entirely in her 20s, keeping almost everything in bonds because the idea of watching a balance drop even temporarily made her too nervous to sleep. Nothing about that choice was irrational. It matched her actual tolerance for risk at the time. What it cost her was decades of the higher growth that stocks, held over a long enough stretch, have historically provided. She's shifted her mix gradually since then, in small steps rather than all at once, which she said made the discomfort manageable in a way that flipping the whole portfolio overnight never would have. There's no universally correct mix. There's only the mix that matches your actual timeline and your actual ability to sit through a bad year without doing something rash, and those two things aren't always the same for every person at every age. Watch what happens once that rough mix exists on paper. The next decision is where the words diversified and diversified enough start to matter. Owning stock in one company isn't diversification. Owning stock in 10 companies you picked because you liked their products isn't really diversification either, if all 10 happen to move together during a downturn. Genuine diversification means owning small slices of an enormous number of businesses at once, spread across industries and countries, so that a bad month for any one of them barely registers in the total. The across countries part trips people up the most, since it's tempting to assume the strongest economy you personally live in is also the safest place to keep all your money. Different markets don't always move in exactly the same way, so international exposure reduces how dependent you are on any single country's fortunes, though it's not a guarantee against loss, since a genuinely global downturn can still pull most markets down together at the same time. This is where a broad, low-cost fund earns its reputation as the backbone of most simple portfolios. Not because it's exciting, but because a single fund tracking a broad market index can hold you a stake in thousands of companies at once, for a fraction of the cost of trying to assemble that same diversification one stock at a time. If you've seen the video on minimalist money rules, you already know part of why this works. Research comparing professionally managed stock-picking funds against simple market index funds has found that the large majority of the professionals fail to beat that simple option over long stretches of time. The complicated approach isn't just harder to maintain here either. It usually doesn't even win. Some of the simplest, most durable portfolios in personal finance circles are built from just 3 broad funds, one covering the domestic stock market, one covering international stocks, one covering bonds, split according to that age-based starting mix, and left alone. 3 decisions made once instead of dozens made every year. There's an even simpler version worth knowing about, especially if 3 separate funds still sounds like more than you want to manage. Many retirement plans now offer a single fund built around an expected retirement year, which automatically holds a mix of stocks and bonds appropriate for that timeline and gradually shifts toward bonds as the target year approaches, handling the age-based allocation and the rebalancing both inside one fund without you doing any of the adjusting yourself. It's not necessarily better than the 3-fund version, it's simply a trade of a small amount of control for a large amount of convenience. And for a genuinely first portfolio, that trade is often a completely reasonable one to make. Here's a number worth sitting with, because it's easy to overlook. A fund charging 1% a year in fees sounds small. Compounded over 30 years, that 1% can quietly consume a meaningful chunk of your total returns, not because any single year's fee is dramatic, but because it's subtracted from your balance every single year, including the years your money would otherwise have been compounding on itself. Picture 2 identical portfolios, each starting at the same amount and earning the same underlying return for 30 years, one paying a full % in yearly fees and the other paying a small fraction of that. By the end of 3 decades, the gap between them isn't a rounding error, it's often tens of thousands of dollars, entirely explained by a fee difference that looked too small to matter on day one. A fund charging a small fraction of a % instead of a full % isn't a minor detail. Over decades, it's one of the largest, most controllable differences in what you actually end up with. I think about my old breakroom stock every time someone tells me they're picking individual companies to beat the market. I wasn't beating anything. I was paying attention to one company's daily noise, while a broad fund, quietly holding thousands of companies at once, would have required zero attention from me at all. None of this means individual stocks are strictly forbidden. Plenty of people build a broad, diversified core like the one we just described, and set aside a small, clearly bounded slice on the side for a handful of individual companies they find genuinely interesting to follow. The distinction that actually matters is whether that slice is small enough that getting it completely wrong wouldn't meaningfully change your future versus being the whole strategy wearing a hobby's clothing. One is curiosity with guardrails. The other is the break room stock all over again, just with better research behind it. There's a specific version of this worth naming on its own because it sneaks up on people who never think of themselves as stock pickers at all. Plenty of jobs pay part of a salary in company stock, and it's easy to let that quietly pile up untouched for years, since selling it can feel disloyal. But a paycheck, a bonus, and a large slice of your investments, all depending on the same company's fortunes, is about as far from diversified as it gets. If that company has a genuinely bad year, it can cost you your income and your savings at the same moment. Diversifying out of it isn't disloyalty. It's the same logic we've been using this whole video, applied to money that arrived in a less obvious form. Once the structure exists, the next question is how money actually gets into it, and this is where a lot of new investors accidentally set themselves up to fail before they've even started. Waiting for the right time to invest, a dip, a correction, some signal that the market has bottomed out, sounds smart and is nearly impossible to execute consistently because nobody, including professionals with enormous resources, reliably knows where a bottom actually is until well after it's passed. Investors who pulled money out during the sharp downturns of 2008 or early 2020, waiting for things to feel safe again before getting back in, frequently missed the steepest, fastest part of the recovery that followed, because the market has a long history of turning upward well before the headlines start sounding optimistic again. The alternative is almost boring by comparison. Investing the same amount on the same schedule every single time, regardless of what the market did last week. Some contributions land right before a dip. Some land right before a rally. Averaged out over years, the timing stops mattering nearly as much as simply showing up on schedule ever did. This is mainly about new income arriving regularly, a paycheck, a bonus, a contribution you make every month. Deciding what to do with a large lump sum that's already sitting in cash is its own separate question, with its own separate trade-offs, and isn't quite what we're talking about here. If you've watched the videos on this channel about automating an emergency fund or giving every dollar a job, this is the same principle wearing different clothes. The contribution happens on a schedule, decided once, rather than becoming a fresh decision every single payday about whether this particular week feels like a good time to invest. Removing that decision doesn't just save time, it removes the exact moment where fear or excitement would otherwise be allowed to steer the outcome. Here's a piece of this that surprises almost everyone the first time they hear it. Even a portfolio built with a perfect starting mix doesn't stay that way on its own. If stocks have a strong few years, they'll naturally grow to take up a larger share of the total than you originally intended, quietly shifting a portfolio that started at a comfortable mix into something noticeably more aggressive, without a single new decision being made. Say a portfolio starts at 70% stocks and 30% bonds. After a few strong years for stocks, that same portfolio, untouched, might drift to 80% stocks and 20% bonds, a meaningfully more aggressive position than the one originally chosen, arrived at without a single deliberate choice along the way. Rebalancing is simply the practice of periodically nudging the mix back to where it started, selling a slice of whatever's grown into an oversized share, and adding to whatever's shrunk. It sounds unnatural the first time you do it, because it usually means trimming the very thing that's been performing best. That discomfort is exactly the point. Rebalancing quietly forces a version of buying low and selling high that almost nobody manages to do on purpose, in the moment, using willpower alone. Here's a practical question worth answering directly, since it's the exact thing that got me in trouble with my break room stock in the first place. How often should you actually look at any of this? For a portfolio built the way we've just described, checking daily accomplishes nothing except manufacturing anxiety on the down days and overconfidence on the up ones, since neither one reflects anything you're meant to act on anyway. I still remember the specific feeling of opening the app first thing in the morning, before coffee, just to see a red or green number, as if either one was actually going to change what I did that day. It never did. It just cost me a few anxious minutes I didn't need to spend. Once a quarter is plenty for most people to check whether a rebalance is due. Once a year is enough for almost everyone else. The portfolio doesn't need your daily attention to work. It mostly needs your daily attention to be withheld. Here's the part almost nobody says out loud, and it's the actual reason any of this works. There's a well-known piece of research on individual investors who hold and trade stocks directly, following tens of thousands of real brokerage accounts over several years. The investors who traded the most frequently earned noticeably lower returns than the market itself over that period. In the study's own numbers, the most active traders earned roughly 11% annually, while the broader market returned closer to 18% over the same stretch, and the average household turned over a striking 3/4 of its entire portfolio every single year. The accounts that traded the least came far closer to matching the market itself. The extra activity wasn't neutral. It was actively working against the people doing it, largely driven by overconfidence, a sense that this particular trade, unlike the others, was the one truly worth acting on right now. A portfolio doesn't fail most people because the structure was wrong. It fails because the structure got interrupted by a person who was so sure this one time was different. That's what a real portfolio is actually protecting you from. Not bad luck, not a weak economy. The version of you a few years from now, convinced that this particular headline means everything needs to change immediately. The entire structure, the allocation, the broad diversification, the automated schedule, the rebalancing, exists to survive contact with that future version of yourself, the one who will absolutely show up at some point, certain that this time is different. Every crash in market history has come with a headline convincing enough to make selling feel responsible rather than reckless. Every recovery that followed looked obvious only in hindsight, long after the people who sold near the bottom had already moved on. The structure isn't there to predict which headline will be the real one. It's there, so the answer to that question stops mattering as much as it feels like it should in the moment. I think about my break room stock again here because the checking, the daily up and down, the eventual sale for a small loss, none of that was really about the company. It was about a system with nothing built into it to survive my own attention. A better structure wouldn't have made that stock a better investment. It would have made my own behavior far less able to damage it. A portfolio was never really about picking the right investments. It was about building something sturdy enough to survive being owned by you. If you've made it this far, you clearly care about understanding money in a way that actually works in real life, not just on a whiteboard. That's exactly what this channel is all about. Every week, I break down personal finance, investing, budgeting, and wealth building into simple, practical lessons anyone can use. If that sounds like something you'd find valuable, consider subscribing. I'd love to have you here. Because the next time you're tempted to check a single stock every day the way I once did, remember what you're actually looking for. Not a better pick. A structure built well enough that checking daily was never necessary in the first place. That's not a lesser way to invest. It's the version that actually survives long enough to work.